Hi everybody, Sean Balcom, Southeast Michigan mortgage guy, and I wanted to talk to you today about an often requested topic, PMI. What is it? How do I get rid of it? How much does it cost? So let's start with the acronyms. PMI stands for Private Mortgage Insurance. And this insurance does not help you in any way. It insures the lender if you default on the loan, and then they charge you the insurance premium for this. So it's been around for a long time, and it's not necessarily a bad thing at all. If it didn't exist, you may only have an option to put 20% down. So some things to know about it. It differs on how it's calculated based on your credit score and the loan to value. There's a few other factors too if you're a first-time home buyer, but we don't want to get into the weeds too much. The biggest things are credit score for sure, and then second, loan to value. If you have a 780 credit score and you're putting 15% down, the PMI is going to be drastically less than it is if you are a 623 credit score putting only 3% down. So you want to talk to your lender about the different options with different down payment amounts for PMI. There's usually some big differences when you go from 3% down to just 5% down. So for just 2% extra down, you could be saving a lot extra on your monthly payment. This is something I always look at for my clients. Now, say you've closed on the loan. Now what happens? Do I pay this forever? How do I get rid of it? So generally, when your loan reaches 80% of the original purchase price, you can request that it's removed. So you'll call your lender, you put in the request, they'll usually have to have you pay for an appraisal, and they'll make sure that you've been making your payments on time, and as long as you've paid it down to 80%, they will remove it. Then there is the 78% rule. So nobody really ever talks about this. I didn't know about it until I read up on it when I got in the mortgage business. But at 78%, then the lender has to cancel it as long as you're on time. Remember, we're speaking generally. There are massive disclosures that detail everything in this in individual mortgage programs and in your paperwork. But generally at 78% loan to value, they're going to take it off. So say you bought the house for $100, you put 10% down, so you have a $90,000 loan. 10 years later, your loan balance is down to $78,000. Boom, it's going to be removed. Now, let's get into something else with PMI. It actually often gets confused for PMI, which is FHA MIP. So MIP stands for Mortgage Insurance Premium, but the way this behaves, the way this functions is completely different than PMI. The FHA MIP is monthly and it's added to your payment, but this is just determined by FHA. They use this money toward the funding of the FHA program, and it's a set amount. Doesn't matter how much you're going to put down, and it doesn't matter what your credit score is. It's 0.55% of the loan amount per year. So it actually goes down a little bit every year. So the main thing to know here is this video was about PMI, is that if you're in an FHA loan, that works a little bit differently. You're going to want to do additional research on that. So if you have any questions on this topic, I'm always available. My information is below, and if you are getting value out of these videos, please like and subscribe. Thank you.